Wait a second, guys. My bell is ringing. Wait, just a second. Okay, now hold on. Let me do this. I think I started. Mm-mm-mm. Oh, did I hit it? Okay, let me try again. Okay. Wait a minute. Okay, welcome everyone to Name Confidential Live.
Welcome everybody to Name Confidential. This is season 3 now. We're in our third season, episode number 2, because we're now doing the bi-monthly instead of 4 times each or doing it each week. So today we have our guest, Asher Rogovy with Magnifina. Asher, welcome. Welcome back. You used to be a host season 1. Now you're on the other side.
Thanks, Ben. Good to be back.
Oh yeah. Well, let's dive right into it. You remember how this goes. We're going to start with the name exposure index. So let me share. All right, and as a reminder for everybody, the name exposure index represents the average equity exposure reported for all of our members. So we have, let's see, last week it looks like it was at 82.87, dropped down to 74.93. I'm not really surprised to see it drop down from last week, are you?
No, not at all.
No. And then you also contribute to this each week, correct?
I actually don't.
No.
My I feel like my equity exposure is too stable to provide any kind of uh, meaningful metric on a weekly basis. So I stopped. And I also some of my strategies are always 100% invested and achieve an active tilt through sector rotation or individual security selection. But it is interesting to see it ticking down. The market's been failing to make new highs. I feel like there's some things are running out of steam in the hot trades. So it makes sense that our members might be preparing for something defensive, but you can always turn around.
Yeah, what are your overall thoughts about the market right now? Where do you think we're heading?
Um, I for a long time I viewed the AI situation like the dot-com bubble, maybe not quite as stretched in terms of those valuation metrics, but I definitely feel like it got ahead of itself. There's a lot of promise built in, and it takes time for companies to apply new technology profitably. So far, the results are that companies have been spending money and not really seeing much of a return. I think they will, but not as soon as the market expects.
Got it. Well, I like it. Well, we have limited time today, so I think next thing we should do is jump into, I believe you want to talk about your core equity alpha. Was that what it was?
Sure. Let me just pull up a little slideshow here.
Perfect.
Can you see that?
Yes, I can.
Okay. So I've been hard at work on a purely quantitative individual stock strategy. Um, my tagline is systematic equity investing with an even keel. I'm a sailor. I love sailing metaphors. I think they work so well for the investment industry. So hope you guys are up for that. Couple important disclosures, yada yada yada. So my firm, I founded it in 2019 after managing private investments for about a decade. Um, and what I think differentiates our approach is we really focus on individual stocks and fundamental analysis and valuation. Um, so for most of my clients, that means handpicking 20 to 30 stocks that I just think are gonna perform better than average, and keeping an eye on them, rotating them in and out. And it's a little bit different than running a model portfolio because customers can come and go. They can deposit or withdraw at any time, and I want to make sure I get good stocks at the time that they invest. So a model portfolio doesn't quite work because just like the market can go into an overvalued state. So I've just developed a kind of handcrafted methodology of identifying promising stocks. So of course it's challenging to scale, and as I take on more clients with evolving needs, I thought of how can I make this more systematic. So that's why I started working on this strategy called Core Equity Alpha. So relative to other common approaches, Core Equity Alpha avoids concentration risk. I think we know about how concentrated the indices are getting, right? 40% of the value is in just 10 stocks that are all of a similar industry. That doesn't feel like diversification to me, does it?
No.
So that's why kind of selecting individual stocks based on those stocks' fundamentals rather than their share of an index makes sense to me. The other thing is that the market can go in and out of regimes, like a trending regime or a mean reverting regime, and it can be difficult to identify which one of those it's in. So I try not to follow the market, but rather just focus on individual stocks that are kind of sailing faster in the race of the market. I told you about sailing metaphors. So I used to race sailboats in the Upper Bay of Manhattan, and it's every boat has the same wind, the same course, but if you trim the sails a little bit better, you can get a little bit more speed, and that will just carry you to win the race over the long run. So that's how I feel a portfolio of individual stocks functions. And the last thing I wanted to avoid was an overly complicated black box model with machine learning and AI, and who knows why it's making the choices it makes. The model should be deconstructible. It should be simple, and you can see exactly why it's selecting the stocks that it does. So those are the problems that I've seen with a lot of approaches, and it has informed my design principles to build up Core Equity Alpha and a couple of others along the same methodology. So it's systematic. It runs only on data. There's no human judgment. It's evidence-based. We've back-tested these models and underlying factors on 35 years of individual stock data, and it's point-in-time data. So there's no hindsight bias, no survivorship bias. The portfolio is equal weighted. This is kind of an important thing to avoid concentration risk, and it also just keeps things simple. And I don't have so many parameters. It's a pretty simple, you could do this all by hand if you had the time. And you can see exactly how it operates. So that's the approach that I'm taking with my quantitative strategies, and I'm very excited about it.
And how many stocks are in the strategy then?
Good question. I have three that I'm running, or I'm going to start the second one on Monday. So my sort of flagship model I call Core Equity Alpha. and it has 100 holdings equal weighted, so 1% in 100 different stocks. And then for our friends with Echo Trade, I'm working on distributing a 25 stock model called Quality Growth Select, which kind of focuses on growth, only on growth factors and quality factors, whereas Core Equity Alpha looks at 4 different factors. And along the same lines, I'm taking an approach of quality value alpha, only looks at quality and value, has 100 different stocks, and it performs very similar to Core Equity Alpha, but it can reduce correlation. So that's 2 different strategies to reduce correlation from the index and each other.
And then how often do you reevaluate the 100 stocks, and how often?
Great question. So we re-rank everything every month. So month on month, you can usually expect about 7 or 8 in and out. A good stock is going to be good, should be a good stock for a long time. But because we do it every month, that also provides an entry and exit window for any new investors. So like with a model portfolio, you don't have to time it, you don't have to invest when it's undervalued. This reruns every month, so month to month, you should be able to get in and out without having to worry so much about timing.
And then are all clients in the same 100, or is there some differences?
Good question. So at its core, this is a rank-based model. So if some clients have ethical problems with like a tobacco company or something like that, we can skip that one and go to the next one. So instead of the top 100 stocks, it's 100 of the top 102 stocks or something like that. So there could be slight differences, and that can really tailor it for clients' needs. Maybe they have stock options in one of the companies and they don't need any extra exposure to that company. That's another good use case for skipping that. So it's very flexible in that sense.
Is there an average hold or a minimum hold period for the stocks?
Good question. I don't recall how long each one is held. Some of them are in and out. Like some of them are in for a month, and some of them are in for, I think, at least 5 years, maybe longer, according to our back tests. So yeah, there is a little bit of turnover. So tax gains are one of the drawbacks, but it just makes this even better for tax advantaged accounts.
Well, cool. I don't have anything else right now.
Okay. Well, can continue to pitch it on why this is a good strategy for allocators, why this is a good strategy to be sub-advised, and that it avoids concentration risk, as we've talked about. And I feel like that's kind of a rare feature these days. All weather entry, you can deposit withdrawal at any time, and it's not really timing dependent. Here's a big one: proxy voting rights. So with an ETF or mutual fund, you kind of surrender those to the manager. But if you care about corporate governance, or really like one of the most important things of owning a stock is being able to vote for the board and on company measures, those are retained with an individual stock strategy like this one. Another good thing of this is it has only a 2/3 correlation month on month with the benchmark, which is the S&P 500. And we talk a lot about diversifying a portfolio across many different companies, but I think it's just as important, if not more so, to diversify your overall portfolio across different strategies, different approaches. I think, I think if there's a good, trend following strategy and a good mean reverting strategy, then diversifying between the two of them and keeping them in balance, it could be even better. For example, this individual stock fundamental strategy might complement a market timing active investing strategy.
Do you have a estimate on how much you generally, like a normal client would have within this, like a range?
So it's 100 stocks, which is a lot, and unfortunately, my primary custodian does not do fractional shares. So I typically ask for a minimum of $100,000. And even then, a couple of stock prices are more than 1,000, so those have to be skipped. But internally, I don't recommend a client to allocate more than 50% of their equity exposure to it. And I feel like 25% is a good sweet spot.
Well, perfect. In that you answered the question about what if a stock was over a certain price, what value would they have to have? So
Yeah.
perfect.
So one custodian does do fractional shares, but we haven't put any clients on them yet. And then it wouldn't be a problem at all. But yeah, that is one drawback. It's 100 stocks that you can't just put like $10,000 into it so easily. So
What have you seen so far in like performance and just your overall interpretation of it over time?
so without making any specific performance claims, it's keeping up with the benchmark pretty well, which I think is to be expected. But given the degree of concentration risk and how concentrated things have gotten for the last like year and a half or so, I think that just speaks to its resiliency. Yeah, everybody's been piling into the same 10 stocks pretty much, and they've been outperforming so many others. And that this has been keeping up with this is a vote of confidence in my eyes.
No, I agree. I like that. Trying to think. I don't think I have any other questions.
Okay, let's see. I think that's my last slide.
Okay.
I know as a mouthful, I'm a verbose member of NAAIM, but I don't know. We talk. It's. I feel like the art of like looking at a company is kind of out of fashion these days. And I know a lot of NAIM members are market timers and outstanding market timers at that. But there's a few of us are more stock pickers and like to look at how a company functions.
Yeah, I mean, it hasn't really been I guess, the trend for a while now, but it might be coming back into favor.
Yeah, I know. When I was a host and Ron was my guest, he showed me this chart of the Dow kind of going up for a decade and then flat for a decade and then up for a decade and then flat for a decade. And I think we've had about 15 years of up. So if we have a decade of flat,
Mhm.
I think that really just benefits all active managers, whether it's market timing or stock selection.
Yeah. No, definitely. That's when we shine.
Yeah. Um,
Well, I know another thing. I think you grabbed your favorite investment quote before we hopped on.
that's right. And it's I don't know, I guess a cautionary tale against rebalancing. It's one way to read it. It's a Peter Lynch quote, who is um, maybe number two after Warren Buffett in terms of actually investing in companies, but he had a completely different approach. And Warren Buffett would choose like, I don't know, 15 companies tops or something like that, or pile most of it into a small number of companies. Peter Lynch would buy like hundreds and then just get some skin in the game. And then once he found the ones he really liked, he would concentrate into a fewer of those. And but his quote, it's not so much a quote because I think he used it a few different places, but it's a metaphor. And it's you don't want to go watering your weeds and trimming your flowers. So I kind of read that as, as like a caution against too frequent rebalancing. Think of just like a 60-40 portfolio and someone who's rebalancing that every quarter or something like that. They just keep giving up a share of the portfolio to what's been driving the returns. So if they rebalance, less than annually, that would probably be better for their clients. So anyway, that's when I thought about that and what it meant, and then I actually did a back test on different rebalancing strategies and found that, of course, if you did it less often, your portfolio has better return, higher risk, of course. But it made me think about whether mechanical rebalancing really made sense, and perhaps there should be, perhaps there's an opportunity in a technical analysis based rebalancing. So if you think about a market regime going up or going flat, when it changes regime or down, when it changes regimes, that's kind of the optimal point to rebalance.
Right. Yeah. That's interesting because I've never really thought that much into rebalancing until right there. But now you got me thinking about it.
Yeah. The hard part is, predicting when the market's going to turn around like that, obviously. But I think as far as a rebalancing policy goes, that would be the best one. Right before the market makes a downturn, you sell your stocks, hide out in bonds, and then before it makes an upturn, you would be overweight in bonds, you sell those down and buy your stocks again.
I think if we could figure that out, we wouldn't be here.
Yeah, of course, I know, but I do know there are a lot of really talented technicians with NAAIM, and viewing rebalancing through that lens might be an interesting area of research.
Yeah, I know when you mentioned it, mixing the different strategies, and there are a lot of different philosophies that NAAIM members are really good at, and I've always been a big believer in diversity of managers in the sense of diversifying through the strategies. And that's why I love NAAIM, because everybody's just got their different cup of tea, their different stuff that they're looking at, and where they want to be the expert in that area. And yeah. So if you think you're an expert and you're watching this and you're not a part of NAAIM, we need you.
Absolutely. I feel like the more the better. Yeah, I'm always I'm surprised by so many of the conversations I've had at the conferences. A lot of times the most valuable thing I walk away with is just a chat in the hallway with somebody.
Just trying to get up the the name on UK. I didn't realize it had music in the background, so when I clicked into it. But yeah, I do want to make sure I put in a plug for the NAAIM UK coming up. Well, shoot, I clicked out of it, so now I gotta look up the
Are
date
you
again.
going?
Oh, April 27th through 29th in Tampa, Florida this year. I am going. Oh yeah. I try to make both of them each year. Are you going?
I am. So far, I've made every one since I joined, and every UK as a walkway of something that kind of sets my I got like a year-long project for my practice, and it's always worth it.
Oh, definitely.
And it's not like it's not like some technical analysis thing. It's not like I go and hear the hear the speech by the white paper winner and to think, oh, I'm going to try and do this technique and better time the market. It's never something like that. It's always something completely random. Could be a tax tip for clients. Could be
It was cybersecurity for us last time. We learned some things about cybersecurity, so we reevaluated.
really
Yeah.
cyber. Hmm.
There's always, I mean, yeah, you never know what's going to pop up. I would never think that we're going to go to a name conference and that's going to be the thing that we put the focus on. Because we do it, we try to have one main thing that we focus on as a company after that. And that was the focus last year. And then there might be some smaller things, but we like to have at least a single focus.
Cool. Yeah, I feel like I don't know if you get this sense too. I feel like name members are independent thinkers in general and always have innovative ideas.
Oh, definitely. Conversations go all over the place when I'm there. I never know. Sometimes I never know where the conversation's going to go.
Cool. All right. Well,
Well,
any
I don't think I have anything else. I mean, unless you got any last thoughts on that you want to share.
nothing's coming to mind. Uh, trying to come up with a good sailing quote, but it's hard off the top of my head. I don't know. I feel like
Well,
everything's
at the name conference, I'm going to ask you more about sailing because that
yeah.
was interesting to me. I was like, oh, I'll ask now. No, I won't take up name time.
Oh, okay. Do you live near water?
I mean, we got land of 10,000 lakes.
Okay, so some small boat lake sailing. That's always good. Maybe do you have a wetsuit?
No, no.
Okay. Um, yeah, I'd love to do some lake sailing. We just moved just north of New York, and the lakes here are actually reservoirs used for New York's water supply, so I don't think we can sail on them.
Yeah.
But I'm still looking for a place.
No, where did you do the sailing when you were doing it?
So right off the tip of Manhattan, we
Okay.
used to race between Ellis Island and the Statue of Liberty.
Oh, wow.
Yeah. It was
Yeah, I'm going to be asking you more questions because I
okay.
know I can go off on a tangent if I,
They,
and
they
if
were,
you want to know more and you're listening to this, you can come to the Name Confidential
yeah,
or
absolutely.
Name Conference and ask Asher.
Yeah, hopefully, is Tampa by the water? Maybe we can get out on for a day.
Oh, I'm trying
Or
to remember
sail.
there was a few different options I heard. I can't remember what they are.
Okay.
I'm sure Susan knows and she's back there like, it's this is what we're doing. But um, it's always fun, whatever it is. I can always find a way to get down with what the big event is because
Cool.
a big part of it is just being around the name members.
Yeah,
So,
definitely.
well, we'll leave it there. I want to thank you again for coming back, being on the guest side
Yeah,
and
thanks, Ben.
sharing all your knowledge there and have a good rest of your Friday. It's nice knowing that we still have a little bit of Friday left after this gets done
Yeah,
because I'm
right.
usually exhausted by the time I did Name Confidential before.
Yeah, what 4:30 on a
Yeah. I'm like, I'm ready for the weekend.
right. Yeah. It's a sunny day. Hopefully it melts some of the snow and enjoy